Switzerland, remember, is the capital of the banking world. But this is a title that it may lose soon.
Shares in Credit Suisse fell by more than 60% this morning.
The stock was worth less than 2 Swiss francs, and this fall is bigger than the Silicon Valley Bank because Credit Suisse is a much bigger bank.
UBS has agreed to take over the 167-year-old Swiss bank giant Credit Suisse in a deal worth $3 billion.
UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
The bank's credit default swap price has jumped to its highest level.
Hi everybody, Credit Suisse was one of the biggest banks in the world, and as we all saw, days after the collapse of 2 US banks, now Credit Suisse got into trouble. And if you look at the magnitude of this disaster, it will blow your mind. This is what the share price of Credit Suisse looked like. Ever since their peak 16 years ago in 2007, Credit Suisse has lost 99% of its share price. And while making this video, it was hovering around 0.86 Swiss franc. And mind you, Credit Suisse was not like SVB or Signature Bank, it was the second largest Swiss bank that at one point contained 1.3 trillion Swiss franc in deposits. And in spite of it being taken over by UBS, even now there is a lot of panic in the market because we are looking at a banking crisis in not one, but 2 continents in the world. So this begs the question, what led to the fall of Credit Suisse? Where did the economics go wrong? How will this affect the Indian economy? And what are the study materials to help you understand this banking crisis better? This video is brought to you by thinkschool's Communication Masterclass course. People, if you love the way we tell stories and if you also want to present your ideas in the most effective manner possible, come join our Communication Masterclass course. Communication Masterclass is a 6-week course whereby I will take you step by step to take you from the beginner's level all the way to a TEDx level presentation skill. And the highlight of the course is that if you have any doubts regarding the course, I will go live on a weekly or a bi-weekly basis to personally answer all of your questions. On top of that, this course also has special exercises that will help you master your communication skills in just 12 weeks. So if this sounds useful to you, join our Communication Masterclass course from the link in the description. To understand the Credit Suisse crisis, we tracked their total assets since 2005, and in that year they had 1.3 trillion Swiss francs in deposits. That's about 1.4 trillion US dollars. And from there onwards, it steadily declined to 818 billion in 2020, and then there was a steep drop to just 531 billion in 2022. That's about 573 billion dollars. And what this tells us is that Credit Suisse's recent disaster started way before the US banks collapse, way before the Russia-Ukraine war, and even before the pandemic. So the question is, what exactly happened from 2005 onwards that Credit Suisse went down from a $1 trillion company to getting close to bankruptcy? Well, this is where you need to understand there are 4 streams of revenue. In these 4 streams, the first stream was wealth management. This is the most important division that generates 37% of its revenue. The second stream of income came from the Swiss bank, which is just like any other regular retail bank in Switzerland. But it is super important because it generates 32% of the bank's revenue. The third division is its investment banking division that contributes to about 15% of the bank's revenue. And the last division is the asset management division. Now initially these 4 branches were doing very well. And if you see, they were making billions of dollars in profits every single year. But if you look at this graph, you will see that Credit Suisse had specially allocated billions of dollars only for litigation expenses every single year. This means billions of dollars were spent in case filings, court fees, arbitration fees, witness fees, and attorneys. The question is, why the hell did Credit Suisse spend so much money in just litigation? Well, this is where the dark side of Credit Suisse comes in.
The bank has faced a host of scandals. In Bulgaria, it allowed drug dealers to launder money.
Credit Suisse has agreed to plead guilty.
Credit Suisse became the first bank in more than a decade to face criminal charges over helping Americans evade tax.
Credit Suisse will pay more than $2.5 billion in fines.
This is the largest bank to plead guilty in 20 years.
Then there was a spying scandal. The bank snooped on its top executive. Last year, there was a massive data leak, and all these scandals led to losses.
To tell you about it, in 2014, Credit Suisse was fined $2.6 billion and pleaded guilty to helping Americans evade taxes for decades. Then in 2017, it was their biggest settlement year, having to pay more than $5 billion to settle with the US authorities over claims that it misled investors in residential mortgage-backed securities that it sold in the run-up to the 2008 financial crisis. Then, in 2019, Credit Suisse was caught in a corporate espionage scandal, where a group of executives were later found to have ordered private detectives to track two outgoing executives. This triggered a regulatory investigation, and its then CEO, Mr. Thiam, stepped down from his position in 2020. So for the past 1 decade, Credit Suisse has constantly found itself in trouble with regulators. But even then, nothing happened because the bank was extremely profitable and it could easily pay the fines. And despite their repeated scandals, millionaires and billionaires of the world and even the corporates of the world continue to see Credit Suisse as a reliable banker. So as long as their customers had confidence in them, Credit Suisse could still make billions of dollars every single year in spite of the litigation. But, all of this changed when Credit Suisse got involved into two high-profile disasters, which are Greensill Capital and Archegos.
The collapse of Greensill dominating headlines.
The collapse of supply chain financing company Greensill Capital embroiled the bank.
I mean, it's a spectacular fall from grace for Greensill.
I know that one hedge fund had decided to short Credit Suisse because of these frozen Greensill funds.
Credit Suisse had provided financial backing to Greensill as it began to struggle.
Archegos-related losses have been really in the spotlight.
The collapse of Archegos brought Credit Suisse $5 billion of losses.
The Archegos collapse cost its lenders a collective $10 billion.
Credit Suisse, the most hardest hit of the banks tied to the Archegos Capital collapse.
To put that straight, Credit Suisse saw a $5.5 billion loss due to its risky exposure to the US hedge fund Archegos Capital Management, which collapsed in 2021. But even worse was Greensill. Credit Suisse was a major backer of Greensill Capital, and this company sold bonds to their high net worth wealth management clients, saying that they were almost risk-free bonds. But in 2021, Greensill collapsed and Credit Suisse was forced to suspend $10 billion of investor funds. And after this incident, the rich depositors at Credit Suisse got frustrated. So throughout 2022, the wealthy clients started pulling their money out of Credit Suisse. And as we saw, asset management was their highest income generating business. So when that decreased by 27% from 740 billion Swiss francs in the fourth quarter of 2021 to just 540 billion in 2022, it was a huge setback for Credit Suisse. And the icing on the cake were the rumors that the bank was shutting down. So all of this put together caused the outflow of almost 100 billion Swiss francs in the last quarter of 2022 itself. And this is quite understandable, right? If you're a millionaire with $10 million deposited and managed by Credit Suisse, even if you think there is 1% chance of the bank completely failing, you would immediately pull all your money out and move it to a competitor bank, isn't it? Well, this is exactly what the depositors of Credit Suisse did. And this is when the bank started derailing. In every single quarter of 2022, the reported net income was negative after adjusting for litigation charges. And Credit Suisse reported a pre-tax loss of 3.3 billion Swiss francs, which is about 5 times the jump from their losses of 600 million in 2021. And guess what? Just when everybody thought things couldn't get any worse, the final nail in the coffin came in with the US bank's failure, including the Silicon Valley Bank. And when this happened, the panic in the market snowballed and it sent jitters down the spines of all Credit Suisse depositors and investors. This is the reason why, if you look at the numbers, it is absolutely terrible. Their stock price had fallen to just 1.8 Swiss francs, which was 74% lesser than the previous year. And more significantly, their credit default swaps skyrocketed in value again. Now, if you know what is credit default swap from our previous Credit Suisse episode, then please skip to this timestamp. But if you don't, here's a very simple explanation of the same. Now people, these words might sound very complex and very intimidating, but don't worry about it at all. I will explain it in such a way that even a 15-year-old will be able to understand this. So just stay with me and listen to this very carefully. Now, like we learned from the previous episodes, just like government issues bonds, there are even private companies that give out bonds. So let's say Adani Ports needs a capital of $1 million or $10 lakh. And because they have such an amazing brand value, they will float a bond and borrow money from common people like you and me. But one person cannot give Adani $1 million, right? So what would the Adanis do? They will break this $1 million bond into 10,000 units, whereby Each unit will be worth $100, and over a 5-year period, the Adanis will pay back the investors a 3% interest. So when 10,000 people buy these $100 units, they're essentially lending the Adanis $100 each and $1 million collectively. And one of these investors is Nitya, who bought 1 unit of this bond for $100. So firstly, the Adanis would pay Nitya and other investors $3 at the end of every year, and after 5 years, they would return the principal amount of $100. This is how a bond works. Now listen to this very, very carefully. Let's say tomorrow there is news that UK and US both could experience a recession, and because of this panic in the market, now Nitya is scared that the Adanis won't be able to pay back her $100. Similarly, even other investors are scared. So this is where an insurance company comes in, which tells Nitya that they will insure this bond for her if she just pays a 2% fee of the bond unit. So if Nitya pays $2 to this insurance company, tomorrow if the Adanis are not able to pay back $100 to Nitya, then the insurance company will pay Nitya $100. This is what you call as credit default swap, whereby an insurance company takes the risk on behalf of the investor, who's Nitya, if the borrower defaults. In this case, if Adani defaults. Now the question over here is, what is the benefit for the insurance company over here? Because after all, Nitya is just paying $2 and she's getting $100 in case of default. So how is this even profitable for the insurance company? Very simple. Just like Nitya, there'll be 15,000 investors who will buy a $2 insurance to insure their $100 units. So if 15,000 people buy the insurance, then the insurance company will have $30,000 in its account. And out of these 15,000 borrowers, the probability is that only 100 of them will lose their money. So the insurance company only has to pay $100 to these 100 people, as in just $10,000, which means they will still make a profit of $20,000. So just like our normal insurance, even here, the insurance company depends on probability to make profits. By the way, this insurance company could be any entity. It could be an insurance company, a bank, or even a hedge fund. So just like our normal insurance, even here, the insurance company depends on the probability to make profits. This is how credit default swap or CDS works. And the cost of CDS is mentioned to the investors in this graph. Now, if this cost goes up, it means that the cost of insurance is going up, which means the risk of the asset is increasing. So in short, if the price of CDS goes up, it means that the risk is increasing. Now, if you look at this chart, you will see the price of a 1-year CDS for Credit Suisse. So back in June of last year, we could buy a Credit Suisse 1-year CDS for just 67 basis points or 0.67% of the total debt that we owned. So this is a very less amount, implying that there is little to no risk in owning Credit Suisse debt. But when we made our last video 5 months back, it stood close to 500 basis points. But now in 2023, this number has shot up to 3,460 basis points. Which means what? The cost of insurance is 34.6% of the debt. So if you buy a bond of $100,000 from the bank, while you were paying only $670 to insure it, now for the same bond, you will have to pay $34,600. And the fun fact is that anything at 1,000 basis points or above implies a high likelihood of default. So obviously 3,460 basis points is just an unbelievable number. So moral of this number story is that if the bank is not rescued, it will go bankrupt. Now had it been some other bank, it was no big deal at all. But for Switzerland, Credit Suisse is a critical part of the Swiss economy. So if Credit Suisse collapses, it will hit the Swiss economy, and more importantly, this incident will question Switzerland's credibility as the banker of the world. This is the reason why the Swiss National Bank immediately gave a 50 billion Swiss franc of credit line to provide liquidity to Credit Suisse. Basically, they guaranteed that there will be no default. Now, the Swiss knew very well that this is not a long-term thing at all, and it's not enough to restore the faith of the depositors and the investors. This is the reason why they arranged the sale of Credit Suisse to UBS Group, which is the largest bank in Switzerland. Now, even UBS operates in the same space as Credit Suisse, whereby they have the business of wealth management and investment banking with offices all across the world. And the only difference between UBS and Credit Suisse is that UBS knows how to not waste its money into scandals and lawsuits. And you know, UBS took such an insane advantage of the situation that while Credit Suisse was valued at 8 billion Swiss francs, UBS barely offered them 3 billion Swiss francs to buy them out, which means they paid only 0.76 Swiss francs per share to buy Credit Suisse. That is a 99% decline from Credit Suisse peak valuation in 2007. So the question is, what is the future of Credit Suisse and what is going to happen to all the money in the bank? Well, firstly, the Swiss National Bank is offering 100 billion franc liquidity assistance to UBS. Secondly, if they encounter potential losses from assets, UBS would bear the first 5 billion Swiss francs and the federal government will bear the next 9 billion francs. And lastly, about 16 billion francs of Credit Suisse bonds known as AT1 bonds will become absolutely worthless. And this is where you need to understand the concept of AT1 bonds, because the same types of bonds are also available in India. And this is a high risk, high reward bond. So again, if you know what are AT1 bonds, please skip to this timestamp. If you don't, here's again a very simple explanation of the same. Now people, if you look at how normal bonds work, it's pretty straightforward. You invest a principal amount with the bank uses this principal amount to give out loans, and in return, you are given interest every year by the bank. Eventually, after the maturity period, your principal amount is returned. So if you invest 1 lakh rupees in a Bank of America bond with a maturity period of 5 years, the Bank of America will pay you an interest of say 10,000 rupees for year 1, 2, 3, 4 and 5, and at the end of the 5th year, it will return this 1 lakh rupees back to you. But when it comes to AT1 bonds, the story is a little different. In these bonds, the banks can actually choose not to have any maturity date at all. Which means, if you invest 1 lakh rupees with Bank of America's AT1 bonds, then Bank of America will not tell you the maturity period at all. So you have no idea whether you will get this money back or not. But in return, they will pay you a higher interest every single year as compared to normal bonds. So if a normal bond is getting you 10,000 rupees a year, in AT1 bonds, you might get 15,000 rupees a year. So as you can see, these bonds have a significantly higher interest rate, which makes them extremely appealing to the clients. But the catch over here is that they come up with some very sharp terms and conditions. And these conditions are as follows. Number 1, the high interest rate paid depends on the bank's financial conditions. So if the bank is in losses, it can even choose to forego the interest that year. Number 2, the investors cannot pull out this bond at their will. Only the banks have the right to do so at their call date or maturity date. So investors can only sell and trade this bond in the secondary market. And most importantly, if it so happens that the bank fails, AT1 bond holders will not be given priority at all. In fact, all the AT1 bond amount can be written off, which means the bond holders have a chance of never getting their money back at all. And this is exactly what happened in Credit Suisse with $16 billion. When the bank fell to UBS, 15.8 billion Swiss francs of Credit Suisse AT1 instruments were written off by regulators completely. So $16 billion worth of investor wealth was completely wiped off. These were the stories, the concepts and the economics behind the Credit Suisse crisis. And this brings us to the last part of the episode, and that is, if the European banks are failing, if the American banks are failing, then what is the impact of this banking crisis on India? Firstly, as of FY22, banking, financial services and insurance from US and Europe, they are a major stream of revenue for the Indian IT sector. In fact, BFSI contributed close to 40% of the consolidated turnover of TCS, and even Infosys receives a similar percentage of revenue from this segment. So we could expect the Indian IT sector's profit margins to shrink a little bit. Secondly, as far as the Indian banking is concerned, there is nothing significant to affect us at all. And more importantly, to safeguard us from such happenings, the Reserve Bank of India has implemented something called the Basel III norms. And this is for the banking system, which was actually missing in case of both SVB and to some extent Credit Suisse. I'll give you a link in the description to help you understand this better. And thirdly, for other kinds of volatility, I suggest you to keep an eye on the credit default swap rates of all the banks that you're actually investing or depositing your money with. For this also, I'll give you some links in the study material, and if you read through them, you'll be able to understand not just the concepts of the video, but other concepts in banking and the banking crisis in general better. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button in order to make YouTube Baba happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye-bye.